This is the Real Estate Investing 365 podcast, your go-to source for real estate investing strategies so you can start living the life you want and get where you want to go. With your host, Justin Hanna.
What's up, everybody? Welcome back, Real Estate Investing 365. Today I got with me Daniel Ameduri. Did I say that correctly, Daniel?
You sure did, sir. Okay,
cool. Well, Daniel is a self-made multi-millionaire. He's a full-time skeptic of conventional thought, a proud father of three. He's the co-founder of Future Money Trends newsletter and futuremoneytrends.com. He's been featured in the Wall Street Journal, ABC World News, Russia TV Today. He's all about his book, Don't Save for Retirement, which kind of goes against what, the baby boomers and that generation, that their kind of whole thought process was as far as career and retiring and everything. So Daniel, I appreciate you being here. You have a ton of knowledge, and I'm just excited to dive into how you got where you are. And then, obviously touch on the craziness that's happening in the world today. So appreciate it, man. Thanks.
Thanks for having me on the show.
Absolutely. So, I usually start this out by going back and starting where you first came from, which I do want to do that, and how you kind of got into all the stuff that you're into now. But we'll touch on a little bit about what's happening in the environment right now. We're in the midst, I think today is March 18th, 2020. So we're in the midst of this coronavirus thing, the stock market's crashing, everything's happening. So what are some of your thoughts about what's going on?
Right now it's an unprecedented time. I would just say to step back and not fall for this trap that, prior to stock market corrections or real estate markets, and then, they try to compare it to SARS and Ebola, 1987 stock market crash. This is just unprecedented. It is what it is. There is nothing we can compare this to. I mean, 9/11, they closed the flights down in the stock market for like a week, but that was it, like a week. We're talking about closing down restaurants and bars and non-essential businesses. And even when, the restaurants and the bars are the ones making the news at this very moment. But let's be real, with the schools closed and gyms closed, and you can't have gatherings of over 10, in some areas over 50. This is closed down martial arts studios, yoga classes, barbershops. This is done. We've never seen anything like this, where you've grinded the economy to a complete halt. So we don't know what the consequences of this are. If it's a short-term thing, let's say this goes for 2 to 4 weeks, I think we can overcome this fairly easily, because it'll just be a hiccup, especially with all the government stimulus and different individual bailouts that's happening as far as with the individual public. That is probably something we could get by. If this went 8 weeks, I mean, that's hard to see what's going to happen in the economy. And I think that's why I'm not a buyer of stocks right now, even though nobody wants to buy stocks. So that's typically historically a time where you're like, okay, this is when I should be buying stocks. However, I can see a lot of bad news continuing for months here, because we don't know where GDP is going to go. We don't know where unemployment is going to go. It's completely uncertain.
Yeah, totally. I totally agree. I have, friends and family that are, not that I'm an expert by any means, but they still ask me for my opinion on the stocks and buying the real estate and all those different things. And I just think I'm not buying any stocks like you. I'm not really a believer in stocks, but when it's down, obviously buy them at the sale. But I just feel like it's going to continue. I don't know. I just feel like it's going to keep going for quite a while. And then you touched on, businesses being shut down. My wife and I own a gym. We're not completely shut down yet. We've lowered the class sizes, but we just got an email saying that most likely they will be shutting us down. We don't rely on the gym for income. It's kind of a side thing. So luckily for us, but all the other people out there, small businesses, we live in a tourist town. A lot of the businesses rely on the weekend traffic of people coming up, restaurants, and they're not having that, and the hourly workers, the lower income people, they're just getting sent home. So yeah, I don't know what's going to happen. It's crazy.
So I don't own very many stocks as well. And the few that I do are the blue chip names, like a General Mills, or, I like safe stocks like Hershey's Kisses and stuff like that. Not Hershey, Nestle, excuse me.
Yeah.
I mean, that's how little I own of these type of stocks, but I do own some REITs to get international exposure. So obviously it's easy for us Americans to have private equity, physical real estate, tons of real estate opportunities for us here in the US. But as my net worth grew, I wanted to diversify and get some income coming from, Japan and Europe. And one of the ETFs, the core ETF that I use is this RWX. I'm not suggesting it at all. Believe me, I don't own any of it right now, just to let you guys know. It was at $40 about 3 weeks ago. I sold at 39, probably about 3.5 weeks ago today. And that stock yesterday was at 26. And I was sitting there staring at the screen. I'm like, man, should I buy some? It pays a 13% yield now because of all these properties. And then you turn on the evening news and you realize that Indonesia's closing, Malaysia, Thailand, everybody's closing. Anyway, I woke up this morning, as it was March 18th, the stock's at 24.
Yeah.
And that's just going to continue, I think, because if you think about it, I mean, yeah, the U.S. is going to bail out its renters and mortgage payers right now. That will last for 4 weeks, but not everybody can do that. Not everybody has a reserve currency. So it's so uncertain and so discomforting. So that's why my personal preference is right now I've got a ton of cash and some gold, and I'm just kind of just waiting for the right moment.
Yeah, no, I agree with you. I'm not saying that we should be timing the market. Don't try to time the market, but I think it's so uncertain. Nobody knows what they're doing. The government doesn't know what they're doing. They don't know what the virus is going to do. They don't know anything. So at least maybe wait it out and see kind of what the infectious rate goes to, see what the economies do, all that kind of stuff. Just wait a little bit longer, maybe until any big moves are made. Because if you have millions and millions of dollars, I guess you're more able to take the hit. But most of our audience here, is not people at that level. It's the average, person trying to gain momentum in life and all that stuff. So maybe you could really screw yourself if you take too big a risk now, that could hurt you for years in advance, So that's what I
Well,
feel
as you know, the great news is that if you're focused and you're focused on preserving first and then strategic opportunities, you've got a once in 100-year event happening right now, maybe more.
Yeah.
So that is the bad side of it, but it's also a once in 100-year opportunity. Always keep in mind that the best businesses, the Johnson and Johnsons, the Walt Disneys, these type of corporations and businesses were created during depression, during economic winter.
Yeah.
And we are potentially, unless this is a scam and this thing all goes away in 3 weeks, which I think that's people buy stocks. I mean, come on, guys, this is not going away in 3 weeks from now. If anything, it could be much worse. So, I don't think there's any kind of rush. There's going to be a blood in the streets moment. And just keep in mind that quote actually from Rothschild is, buy when there's blood in the streets, even when it's your own blood. So at this time, for most of us, I would say we're not bleeding. So I think that'll be your moment when you feel extreme pressure and emotional pain and you see it around you. That's when you probably should start buying. But right now, how many people are you hearing? Oh, I bought the S&P last week. I bought the S&P on the last dip. Okay, that's not the type of environment where you've reached a bottom. That's the type of environment where you're still stuck in the old bull market thinking.
Mm-hmm. Yeah, no, I totally agree. And yeah, like you said, don't just up and stop doing stuff. Like for us, for example, I think we have 2 offers on properties going out today. And, so what we're doing to compensate for what's happening, because we don't know whether it's going to go down or up, but, we just build in contingencies. We say, for one, have more contingencies over the next 45-day escrow period to pull out. And 2, we write in, let's say a 20% lower ARV on the property and a 20% lower rent as our backup plan, just to kind of give that, if it does happen, we can still have an out or have a contingency plan in place that, when stuff does crash, so we won't just be stuck with, thousands of dollars in overages every month that we're having to pay out of pocket. So that's what we're doing anyways. So I don't know, it's kind of sobering, the whole thing.
It's times like this where you just have to get back to the fundamentals of delivering value to other people, whether you're an employee or a business owner listening to this. Just start delivering more value. I mean, just start thinking about what are 10 new things I can do for my clients right now? What are 10 things I can do for my company? Because if there are going to be significant layoffs or businesses that get cut, you want to make sure you're either at the back of the list, or if it happens to you anyway, you're the first to come back, because the recency of that person and that company knows that you're so valuable. Because while everybody else is just sitting there staring at their smartphone right now, you're the one over there. Hey, Let's implement this. Let's do this. Let's get this going. Or, it is what it is. But, keep in mind that typically, unless you're, financially free with passive income, that your biggest revenue generator is the person in the mirror. So make sure that is being treated as your greatest asset.
Yeah, definitely. That's for sure. And whether you like Grant Cardone or not, um, I remember him saying in 2010 when he, lost most of his net worth or whatever, and he kind of like started his way back up. Uh, he said he was down to like, $7 million total, which seems like a lot to us, but when he's almost a billionaire now, 7 million is nothing.
Mhm.
He put it all in. He just like went all in, like what you're saying, like, okay, if it's down, just like this is a time to grind it out and look for extra deals, and then make yourself more valuable, put out more free content, help as many people as you can. So then when it starts to come back up, you're ahead of the trend, you know what I mean? So that makes a ton of sense what you're saying for sure. But besides all that, we'll probably touch on that more later on in this podcast. Why don't you kind of give us a background to who you are, why I look at you as like knowledgeable in this field of economics and money and all that stuff, like who you are, where you come from, and then we'll go into like all your businesses that you have now, especially your real estate and that sort of thing.
Sure. Well, Justin, I started off as, my goodness, my earliest memories of wanting to be an entrepreneur and an investor and a saver. I used to do businesses when I was a kid and get kicked out of, classes. I was competitive even with the teacher. He was selling pencils for 10 cents. I was selling them for 9 cents in fifth grade and got in trouble. And it just went on and on like this my whole life.
Mm-hmm.
I couldn't wait to be done with school. So as soon as high school that was it. I got the hell out of there. I started buying my first rental properties at age 18. I owned my first business, a gym. You had mentioned you own one. And right off the bat, and really just got to work and just always thrived and enjoyed being an entrepreneur. The unfortunate thing, and I guess it's fortunate in hindsight, is that when you're buying real estate at age 18 in the year 2000 in Southern California, by 2004 you're thinking you're pretty smart.
Yeah.
Because I was buying at the beginning of what would ultimately become the greatest housing bubble of all time. And so that caused me to make mistakes leading into 2008. So even though I'm on YouTube and those videos are still up, and that's what kind of started this whole process of creating a Future Money Trends blog, is that I had predicted, because I was buying foreclosures, I had predicted the collapse of Lehman Brothers and AIG and Washington Mutual and Freddie and Fannie, the collapse of the stock market. I put it all out there on March 18th, 2008 on video. And I said that it was going to happen between September 2008 to February of 2009. Now, in my mind, I was like, this thing is going to implode in June. But I was like, I'll pad it. Well, luckily, little did I know when I padded it, it actually hit the nail right on the target there with Lehman Brothers. And so when that happened, that channel got big, and Google started paying me, and it was a really neat thing. It was starting to get paid for just doing my hobby, which was talking about the economy and real estate and stocks, personal finance, things I've always loved and been very passionate about. But at the same point in time, I was telling everybody to sell real estate in 07 and 08 publicly. I was buying as much as I could, thinking I needed to be like a squirrel. I was going to save up for the winter. I needed to get as many as I could. And unfortunately, I did not time that market at all correctly. I totally imploded. I did tons of short sales, foreclosures. It was a real disaster for me, where it ultimately led me to 2008, being in a bankruptcy attorney's office. So here I am. Everybody's on the internet saying I called this whole thing, and I've literally wrecked myself financially. Didn't make anything. And so by 2008, 2009, very depressed, really not feeling well. Ended up getting a job for a grocery store. My mind is like, we're going into depression. I'm screwed. I had my chance. I blew myself up. And it really took my wife's encouragement. And luckily I had this hobby that was doing well on YouTube to really even like pick myself up and dust myself off. And a lot of that intro right there is in the details of it is in my book in the intro, and your subscribers can read it free at futuremoneytrends.com/intro. And it actually starts off with my wife. We sold a ring. We went through very hard times for a few years.
Wow. Yeah, his book's right here. I got it on my desk. It's actually on the YouTube people that's watching here. It's called A Millennial's Guide to Financial Freedom. Don't Save for Retirement by Daniel Ameduri. It's good. I haven't finished reading it yet, but I've definitely started. And so it kind of goes into the same detail about what I kind of always preach to, is like, don't rely on, your company and your job. And, you got to make your own choices to make yourself financially viable in the future. So, a lot of what you just said right there about, you said in 2000 when 18-year-old kids buying real estate, and you felt like you're doing everything, you knew it all and you're doing so well because the economy was booming.
Yeah.
Sounds pretty similar to 2011, 12, 13, 14, 15, everybody's making money. Property's all there. And now we're in what we're in now. So I think I wonder how that's going to play out, if it's going to be the same, but we're about to find out. So you said it like that was probably when you're about 27 years old, you're on the brink of bankruptcy. That's when you lost foreclosure and bankruptcy and all that stuff. So how did you kind of pick yourself up from that and then get your, for one, mindset? And then what actions did you take to start moving up? Because you obviously did extremely well.
Yeah, it took a little momentum from this hobby on YouTube. And then my wife never giving up on me, because I had given up on myself for the first time in my life.
Mm-hmm.
And I'd always felt this destiny that I would be wealthy and I would get this done in my life, buying my freedom, I called it. And honestly, I just let go of that dream. I was like, threw in the towel. And my wife just kept encouraging me. And this went on for months. And she's like, Danny, you should take the YouTube channel and start your own website, and let's chronicle the things we're doing to save money and the things we're going to do to invest. And I'm just like, for 6 months, I just blew her off. And finally, we created futuremoneytrends.com. And Future Money Trends was basically me just researching the economy and stocks, because people had an interest in that from the YouTube channel. And I would share everything I was learning. And I started off as just more of like a research letter. And then it turned into something that tracked what her and I were doing. And we would send out these crazy ideas on how to save money. And those articles would go viral. Major websites would pick them up. We would do videos on how to save money or what we're doing to invest. And same thing, they would just go viral. So that built up the futuremoneytrends.com website and the audience. And then I started getting advertising revenue. And then what we would do is we'd take all the money and we would just start buying passive income. So that became our new rule. So one lesson we learned was that we had too much focus on capital appreciation and speculation prior to 2008.
Mm-hmm.
From 2009 to today, we almost exclusively focus on cash flow. So we figured no one goes broke from profits. And we minimized our lifestyle for a few years. And we did what we had to do. We sold her ring so we could pay off our cars. We really focused. And we just had this rule. If it didn't mail us money or ACH us money, we weren't buying it. And we lived like that for 3 straight years. And that's exactly how long it took to where the passive income had snowballed to where it actually paid for our basic lifestyle. So there's so many different versions of financial freedom that people have in their head. My personal one at the time was just focusing on, can I get my water, my electricity, natural gas, housing, groceries? I'm talking basics. I'm not talking about your wine and your fine dining and your luxury cars. I'm saying, so that's what I wanted. I just wanted to get that monkey off my back to where I could say, okay, because 2008 obviously scarred and shook us. So I was like, at this point, the main focus is just not being poor. But what I quickly learned from 2012 on was that by doing what we did, it just snowballed and snowballed. And then it just got bigger and bigger. And all of a sudden, your income is just, so much greater than your expenses. And that's really what the book Don't Save for Retirement is like, screw the 401ks and all these tax deferred things. Focus on just getting checks into your mailbox and watch what happens.
Yeah, I totally agree. It's so funny. It's exactly what I've told people, like I've mentioned before on the podcast, but I'll just highlight one purchase that we did. We did one purchase of 12 units. And I think, okay, I know people that work for 30 years that, are hoping on a pension of, let's say, $5,000 or $6,000 a month after 30 years. Well, this one 12-unit purchase, cash flows me now $3,100 a month. And after 30 years, I pay it off. It'll be $12,000 a month in one purchase, and I purchased that at 27 years old or whatever I was right at the time. So it's just, if you look
That's a
outside,
pension right there.
it's a pension. It's a whole pension. And I don't have to do hardly anything. I don't have to go to work for 30 years to do it. It's just like kind of, as long as I keep an eye on it or whatever. So that totally makes sense. What kind of passive income did you guys end up focusing on? Was it real estate?
Yeah, because initially I didn't know that you could make passive income from anything besides real estate. But at the same point in time, real estate is the best place to get passive income because it has so many tax advantages. You can use leverage effectively. People say, "Oh, you can use leverage on stocks." Yeah, you can if you're a professional. Otherwise, you're going to blow yourself up. Let's be real.
Yeah.
Real estate, it's much easier to do. There's banks involved. I mean, it's a much more orderly process. So in the beginning, we only did real estate transactions. Today, we have many different ways. We have passive income from farming to we do a lot of mortgage-backed notes. So we like to diversify with businesses and everything you can think of, and even now dividend-paying REITs and stocks. But initially, it was all focused on real estate, and because we had wrecked our credit, we had to do all seller finance. So it wasn't even like I didn't even make it easy on myself. Here, rates in 2010, 2011 are probably like 3.5%, 4% maybe. And I'm having to make these things cash flow at 6 and 7% because that's what the sellers are doing on the seller finance deals. So we end up doing all seller finance deals, and we continue to do them for 12 years now. Now I'm actually on the flip side. Now we're starting to do seller finance deals where we're selling properties as seller finance deals.
Okay, can you kind of go in what some of the benefits are of seller financing? Like, why should somebody? Because me personally, I think seller financing. I've done a seller financing deal. Not that I financed it, but I've bought a property with seller financing. And it's just, I think it's honestly a lot of times far better than conventional financing can be. So can you go into some of like the reasons why somebody should look at seller financing as an option?
Yeah, number one, if your credit's wrecked, then it immediately becomes an option for you because seller financing is more free market based. It's going to be on negotiated terms between you and the seller. You'll negotiate the length of the loan. You'll negotiate the down payment. You'll negotiate the interest rate. You'll negotiate everything. And it's much more market based. So that is one thing that I also enjoy about it. You can create all kinds of incentives and terms. You could say, look, I'll have this thing fixed and rehabbed within 2 years. So we'll just do a 5-year balloon payment on it. So a lot of sellers might be interested in that because they know they're getting their money back within 5 years, or they're taking the house back, or you're going to refinance out of it. There's many options. So that's one reason. Now, if anybody's looking for more than, let's say, 3 units, 5 units and above, seller financing is actually quite common. But below that, I mean, the duplexes, the fourplexes, you can also find them. And so that's if you're looking to get a fourplex, but perhaps you're having trouble getting a bank loan, you might be able to find a seller finance deal, a fourplex deal. Same thing with properties that are damaged. One of the reasons we use seller financing is because we focus on our flips. We focus on properties with foundation problems. Well, number one, no bank in the world will loan money on a property that's got a foundation problem because it's considered like red tag, uninhabitable. So what we like to do is approach the sellers and say, look, I have a solution, but first let's just talk money. How much money do you need to walk away from this property? And they'll tell you $5,000, $10,000, whatever. Because of course they probably tried to list it. It's a nightmare. Nobody wants to help them and touch it. So like you're there, here's $10,000 or sometimes $5,000. And sometimes you pay them in 6 months. Sometimes you're like, I'm going to give you $1,000 now and I'll give you $10,000 in 6 months. And what I'll do is I'll have them essentially, I'll assume the loan, or I'll do a wrap, which is basically me making their mortgage payments. So the property title goes under my name, but the mortgage stays put. And just so everybody knows, there's a mortgage clause that says they could do on sale clause where they could accelerate the mortgage. I have Googled the heck out of this. I've spoken to every real estate investor. I've been doing this for the last 12 years. No one in the world, I've never heard of anybody this happening to. Because bottom line, if you're making the mortgage payment, the bank doesn't care. And that's just my unlegal opinion. But so that's what we do. So we do a lot of these assumables. So I don't actually have to come out with a lot of money. And now I can fix the foundation problem, which I discovered is a $5,000 or less problem. So it's not even that big of a deal. But it friggin' makes the house unpurchasable and undesirable to everybody.
Yeah.
So you get it, you fix it, and then I try to sell them within 6 months. Sometimes they're listed within 30 days of us taking them.
Yeah, no, I have another buddy he's in West Virginia, I think. His name's John Scholler. I had him on the podcast a while ago, but he loves buying houses with foundation issues and these issues that most people think are huge ordeals. Really, they're not. Like once you do one or two of them, it's not that big of a deal. And but everybody's scared of them, you know. So that totally makes sense. How were you finding these properties? Because you know, were you direct mail? Were you just like networking? What was your avenue for finding the deals?
I would try to find the realtors that are moving a lot of properties in the cities that I wanted to buy in.
Mm-hmm.
And I simply let them know that I was the foundation guy. Because what happens is if the discount is deep enough, I may just keep the property and turn it into a rental property if it cash flows.
Mm-hmm.
That's how I was personally doing it. And then a lot of times there's a few experts in seller financing in your area that you're looking for. And those people are perfect because they're going to just keep sending you deals. Also, if you search or Google or you look in your area on Craigslist, there's always real estate wholesalers in your area.
Mm-hmm.
People sometimes give them the nickname bird dogs, but you can put yourself on their list as well. Same thing. They'll have a lot of seller financing deals.
Yeah, for sure. Okay. No, that's good. So were you buying these properties out of state or was it local to the San Diego or Southern California market?
Both. So
Both.
out of state, I liked Central Texas. We did buy some in other states, but that was my main stomping grounds was Central Texas and Southern California.
And then I assume like in Texas, you had, you know, contractors on site and people that managed the property and did all that. So how did you find such a good team that could like handle the foundation issues for you?
You know, it just relationships develop. You know, you'd get like 5 or 6 bids on the foundation. I noticed this one company was significantly cheaper than the rest. Started hiring them. They end up also being quicker and they just got it moved and now they just become the go-to company. So anytime there's a foundation problem, sometimes the rentals even get them. And I just call up this specific company and they fix it in a minute.
Sweet. Okay. So it pretty much comes down to just networking, going out there. I touched on that in the last podcast was just, you know, you have to be willing to interview a lot of people and have your, you know, ideas of what a good and bad person is. You have to talk to enough people to where, you know, like when you're getting screwed or when it's a viable option, you know, whether it's an agent or a contractor or a property manager, you just have to talk and network to more people and end up learning that. So definitely makes sense. Well,
yeah, good referrals are good too, right? Because obviously realtors who have just made money from you do not want to give you somebody who's going to make you think ill of them. So right. I always ask the realtors too, what are your top handymans that you can recommend me?
Yeah, for sure. And like, if you're getting into a new market that you don't know, well, like you said, go find the top agent in the market. And maybe the top agent doesn't have time to work for you, but usually let's say top agents have a team and they'll point you to one of their, you know, team members that is plugged into all their systems and all their acquaintances or whatever their contacts in the area. So it's just, like you said, just reaching out to more and more people. So that definitely makes sense. So I don't want to just focus just on real estate because of all the stuff that's going on right now in the market. And you've done so many different things. So what other type of investments did you guys end up getting into besides just real estate?
So on the cash flow side, we started loaning money to businesses, small businesses. Mm-hmm. And we started getting into like farmland investing and private equity. But then on like making chunks of money, we got into venture capital, which is very fun. And I highly recommend it for anybody who's passionate about, if you're passionate about technology or, I mean, mining or anything to improve the world, man, the entrepreneurs and the investors involved in venture capital are the biggest optimists you'll ever meet because they all think they've got the next Facebook, but probably 1 in 1,000 do, or maybe even less. So a lot of these ideas don't turn out well, but it's very exciting because you're actually the same thing. If anybody's ever seen the show Shark Tank, that's what venture capitalism is. And what I did was, instead of investing in ones that were private, I started to look for ones that were almost going public. So they're looking for money, they're looking for exposure, and I would contact them and try to get into their earlier rounds. And that's what we started doing, because what we found out was you can invest in companies and you can get something like, it's called a warrant. And basically gives you the option to buy more shares. So for example, I might get 1 share at $1, and I might get one warrant that gives me the right to buy another share at $1.25 or something. So let's say the stock IPOs at $2. I can sell all the stock that I bought at $1, but I don't miss out on the potential speculative ride up because no matter what, I have, let's say, a 5-year warrant that at any time during that 5 years, I can call up the company and say, I'm now exercising my right to buy another share at $1.25. And of course, it's not one share you're buying hundreds of thousands or even millions of shares. So that is why I like private placement investing, because it gives you asymmetrical risk. If you buy at good terms, I can sell and get my initial money back, and I can essentially hold these warrants where I have zero risk at this point, but I'm in the game, because if that stock goes up, if they're successful with their business, I can call in my exercise my right to purchase more shares.
No, that makes, so what you're saying is let's say you buy 10,000 shares at $1, just to say, and then they give you, say, okay, you have your 10,000 shares, but now you also have like a side option to buy 10,000 more shares at $1.25 for the next 5 years. So like you said, it IPOs at $2. You now doubled your money if you sell that 10,000 shares, and then the stock continues to go up, and you say, hey, I want to buy 10,000 more at $1.20 that you gave me the warrant on. And so if it's at $5 a share, well, then you can turn around and sell that at $5. Maybe there's a time frame there that you have to hold it for or something like that, but that's essentially what you're saying.
And then think about it. Even let's say the IPO was a disaster and the stock goes down 30%. Okay, so you still sell the shares. Now you're down 30%, but at the same point in time, you still have the warrant. So if things turn around or improve, you still have the potential to recoup more money or even profits in the future.
Yeah, no, that makes sense. So how did you you mentioned that you would contact these companies and see if they needed investors. How would you kind of get into that whole world? Because that seems like even a farther world than investing to some people, right? That's like even farther out there. Venture capitalism is the next stage. So how did you get into that?
I talk a lot about at futuremoneytrends.com when these opportunities come up. Because what I initially did was I would actually contact the companies and tell them, hey, can I get on your list for private placements? Can I get on your list for your next financing? Because all these companies are constantly raising money. So that was kind of the easy part, just calling up a bunch of companies or funds. You can even call up like certain brokers. If you look at the press releases of companies, typically it's kind of the same. Like it's like the Canacords of the world, the Raymond James, not the regular retirement one, but their actual brokerage house that are funding these deals. So you would just call them up and say, look, I want to be on the list. Or you can call up a regular traditional stockbroker or Google one that specializes in private placements and get on the list. So, but ultimately what happened was I started getting contacted by these companies because I was already making these investments. I kind of got on the list of somebody who was investing. And so they started pitching. So I get, they call them decks. It's basically an investor presentation. And I'll get, 5 to 10 decks a day. And sometimes I look at them, sometimes I don't look at them for days. And then I'll open them up and, kind of my strategy, because this is very speculative what we're talking about, is I try to find people who are on their second go around. So if they've already built $1 billion cannabis company or mining company, or let's say if it's real estate, because I love investing in anything private equity real estate, I try to find people who went through the 2008 crisis because that's a pretty damn good resume if you're still around and you were doing real estate back then. So I try to look for people who have been around, been doing it. This is not their first rodeo.
Yeah, no, definitely. And then, so we touched on the book earlier. Let's dive into a little bit more about why you wrote the book and exactly what it's about. So you mentioned it, but why write the book? This is called Don't Save for Retirement.
It's a great question. I never planned on writing a book. What happened was my wife and I were in another attorney's office, not the bankruptcy attorney's office. We were in a trust and will attorney's office, and we had just signed our will and our trust, and we've got all these whole life policies and everything's like perfect. I'm like, okay, great. And then I turned to her, I was like, what about the knowledge? And we really realized that the knowledge was not going to be passed on the way we wanted it to be to our children if something happened to us. So initially, I was going to write a manual for the family on how to be smart with money and how to build wealth and how to become financially free and the importance of your time and your freedom. And that was what it was going to be. And ultimately, halfway in, I was like, this has got to be something we share with everybody, because essentially the book, Don't Save for Retirement, is a good chunk of it. Half of it is the story of how my wife and I did it, with real stories, real applicable things you could do and we did. And then it's the investments and the way of thinking of investments where you want that passive income of what we're doing right now and what we actively continue to invest in. We provide links and websites and everything. So we talk about all of it in the book. And so that is basically something I definitely handing off to my children, but it's something that I'm happy to share with everybody because I think it can help people. It's a simple read and it's very applicable. I didn't get into like any complicated things. I got it. If anything, but I didn't be, it was not like a generic book that just tells you, oh, think, positive and write down your goals and blah, blah, blah.
Not the
No,
secret.
I did get into the specifics of things we did to save money for, which we've taken a lot of heat for some of them because some of them were very extreme.
Yeah, no, that makes so much sense. And that's something, I think previous generations for the most part, and I'm sure a ton of people today, they don't really talk to their kids about money. So like what we do, we have 3 little kids, my daughters are younger, 6 and 3, but my 12-year-old boy, especially, I'll talk to him and tell him about our real estate or our other investments that we have. And I'll say dollar amounts to him, like, this is how much we're buying it for. And this is what we do. And we rent it out for this much, or we refinance it for this. And I try to get it into his mind. And even with my 6-year-old daughter, I say things like, see that building there? We bought that, or we're buying this. And just to get it in their head so they can kind of understand what's going on. And so that's even better that you wrote it in a book, the same things that you're teaching your children, that other people need to know the same thing. There's millions of resources out there for this stuff, but you can connect to people better than, there's probably a core group of people that you'll connect better to them than anything else will. You know what I mean? So to put that stuff out there is awesome. So, you mentioned the extremes that you guys went to save money. And like in chapter 3, you talk about saving money and deep cuts. Can you kind of expand on that a little bit more? Like, what are some of the extreme things that you guys did?
Sure. Chapter 9 is all about the kids because I was almost going to write a book. I was like, after writing this book, I was like, I think I'm going to write another book on how to teach your children about money.
Uh-huh.
And I was like, but I really don't want to write another book. So
Yeah.
I tried to squeeze it all in chapter 9. So start there. You'll love that.
Perfect.
The 3 little kids, because I have a 5, 8-year-old and a 10-year-old. But with extreme things we did, my wife and I squatted in homes. We were in very hard times, and we had a friend who was letting his house go into foreclosure, and we gave him $3,000 and said, can we just live in your home for as long as possible? And that's what we did. We had dogs who had medical bills, and this is where we get so much hate. It's hard to even share this story anymore because everybody's taking the fun out of it on the internet.
Yeah.
But we had dogs who had medical bills, and we gave them to like a home that housed they're wiener dogs, and basically they had like 25 wiener dogs at this house, and they took them in. It was a good home, but we got rid of them because it was about $150 a month, and at that time that was just not something we could afford, because in 2009 we had our firstborn, so we had a baby boy now.
Well,
So
I don't see, I can see why people, they get all crazy about that. But at the same time, what are you going to do? I know there's tons of animal activists and things out there, but your baby, your human baby that just is born, is more important than that little wiener dog. Like, you still want
to. We didn't abandon them. I didn't like put them in the pound. They had a beautiful life, but so the dogs, we got rid of the dogs. We sold our wedding ring. We sold everything we could. We moved far away from where we were raised to a very not impoverished area, but not a wealthy area at all. I'll tell you that. And we really humbled ourselves. We stopped eating meat. We stopped eating out. We stopped attending a lot of parties. This was back when you actually had to have cable. We cut the cable. We cut the gym. I mean, we stripped it clean. And people think it's extreme, and it was at the time. But it wasn't permanent. Believe me, we live a very good life now.
Yeah.
But it was something that we just sucked it up for like a year and a half, 2 years. We had that really live like poor people moment. But it was all worth it. And I'd do it again because honestly, it was a very simple life. It didn't take any joy away from our lives. We were very happy people.
Yeah, and kind of in times like that, I'm sure that you kind of find things to connect better with your spouse. You know what I mean? Because sometimes you get overwhelming and stressful, and I'm sure there's arguments that happen. But at other times, you feel more connected. You guys are relying on each other to help each other out, and I'm sure you find things to do that you enjoy so much more than like today. You're so connected to Instagram or social media or all these different things. So I'm sure those bad times, just like what we're going through now and everybody's quarantined at home, you're kind of finding ways to pass the time that you might really enjoy. And it might, look at the benefit, the positive side of all that for sure.
Yeah, no, it was a beautiful moment in our lives. In hindsight, it made us who we are today. And it's funny with this coronavirus, my wife comes up to me the other day and she's like, "What's going on? What do we need to do financially?" She goes, "If you need me to lock it down, I can do this." Like really like cut the budget or something. I was like,
Yeah.
no. I was like, it's fine right now.
Yeah.
Right now everybody's still paying their rent.
Yeah.
But I told her, I'm like, I don't think it's going to get that bad. We'll see what happens.
For sure. Well, okay. So what do you say about millennials? A lot of millennials say that, not just millennials, but that, they don't have the same opportunities that the baby boomers had or previous generations had. And it's so much harder today or whatever. What do you kind of say to that? Do you address that in the book as well?
I do. I think the opportunity for millennials is, better than ever. What a day to be an entrepreneur. You can start a business for $10 at GoDaddy.
Yeah.
You can invest in things that were only exclusive to hedge funds and Wall Street. Just not even like before 2012, you could not crowd share into buying a Costco building or something.
Mm-hmm.
People used to have to actually whip out a newspaper and circle the classified ads and drive around and look for real estate deals. Now you can sit here and look for Craigslist real estate deals or wherever you get your deals from. I can search Austin, Texas. I can search San Diego, California. If the market's hot in Boise, Idaho, I can start searching there. The opportunities are unbelievable for millennials. So I think the problem with the millennials, and I do address it in the book, where they get this stigma of having it harder, is that they've tried to apply the 1980s lifestyle, the 1980s portfolio, I call it, or the 1980s way of life to their own life. Now, if you try to repeat the baby boomers' life into your life, you are going to fail and you're going to have bad results. They had a much different world. That world worked great for them. It's not going to work out well for you. And what I mean by that is the baby boomers had a reasonable expectation that they could come out of college, get a nice corporate job, go up the corporate ladder, and perhaps get a pension or get great employee benefits. We live more in a freelance economy, and if you try to apply the old way to the new way, you're going to be miserable, and that's where that misery comes from some people or these articles. However, if you do what a lot of millennials are doing and embrace the freelance economy, the mobility economy, the economy where you don't even need a car, and I went carless for 4 months just to see how it worked. I loved it. I would have never not done it, but my kids have bikes and surfboards, so I need to get a truck.
Yeah.
Otherwise, I went Uber only from, it was last year in 2019, like from like May to like September. And I really enjoyed it. And millennials can work from home and they can work from other countries. So I think once you embrace what we have in front of us with technology and all these apps and all these conveniences, I think then you realize how good we have it as millennials.
Yeah, no, that's for sure. There's one guy I really follow a lot. His name's Andy Frisella, and he's like he owns multiple supplement companies and all this stuff. He's built $1 billion company from scratch. Anyways, what he says is the same exact thing. He started his company in 1999 and he didn't have the internet and all that stuff back when he started, and he struggled for years. And he's like, it took him 10 years of no income really in his business before he started making real money. Right. And he's like, you could go nowadays he says you can go do what he did in 10 years in 3 years now with the internet and social media and the marketing that's out there and the ways to contact new people and find partners and network and all that stuff that's there today that wasn't there in 1999. You know what I mean? So yeah, it's unlimited out there. It's just that we have to be willing to expand our horizon and just like work hard. So I do want to touch on one thing you said about starting a business for $10. What's a quick tip that you have for somebody, how does somebody have an idea to start a business, like a small business, or like, can they start it with anything, or kind of a background to how to start online business?
It depends on what you're interested in. And a lot of people I talk to and consult with is helping our subscribers turn their jobs into a business. So perhaps you're a city planner, even for a government building or government, or you work for a small company. If you approach them and say, look, I want more free time with my family, et cetera, I want to expand my opportunities. You're paying me $70,000 a year. How about paying me $50,000 a year and not worrying about my benefits and stuff? Because it's a big boogeyman, but it's really not that big of a deal taking care of your own. And then you can now go out to the neighboring city or a neighboring company and make a new client. So now you already have one client, and they're a pretty damn good resume as well. So that you already have one referral, one client, and you're making your current employer your first client. Now, as far as online businesses, there's so many different ways we can either share things, teach things, provide value, advertise yourself using the internet. I use email. You think about it, if somebody in 1980 wanted to send 200,000 people a letter, that took a lot of paper and stamps and postage and logistics.
And money.
Today, for a few $100s a month, I pay MailChimp to handle the whole thing, and they send everybody an individual email. They all get it at the same time, but it doesn't get spammed. But it's so easy to reach out to people. It's so easy to contact people. If you're a podcaster, you want to start a podcast, perhaps on a subject that you're interested in, you can reach out to the experts. Everybody's very, very accessible today. It's not like, if you tried to reach out to like a billionaire, let's say even 15 years ago, 10 years ago, probably impossible. You'd have to call their family office or whatever, and you'd never get a call back. Now you can literally tweet them or comment in their Twitter account. And most of these billionaires don't have a lot of followers unless they're like famous, like Mark Cuban.
Yeah.
But most of them, they get like 3 retweets. So you can actually directly contact them and speak to them. And, I've interviewed several of them when I used to run a podcast, and I was always shocked because they were so accessible.
Yeah, no, that's definitely true. I mean, I got you on the podcast.
Yeah.
I think that was right over LinkedIn is how, or something. I'm not sure exactly how it ends up, but there's so many ways is what we're getting at to contact new people. So that all makes a ton of sense. Well, let's kind of circle back and touch back on where you think the economies may be headed, what you think the future is bringing, and what people should do in the meantime. I know we touched on it earlier, but we'll kind of round it out with talking about that again.
I've created something at Future Money Trends, at futuremoneytrends.com/checkmate. If anybody wants to go there, you can get regular updates on the current situation. Man, it's hard to say. I'll tell you this. 8 weeks ago, I would have told you the stock market was going to 35,000. Real estate was going to be smooth sailing all year long. And we really were set up for a very nice economy. In fact, in Idaho, I was at a conference with Tony Robbins and Ray Dalio, a billionaire, his famous hedge fund manager, and Paul Tudor Jones, the guy who had the most successful trading in the 1987 crash. Both of them were saying, like, look, it's blue skies. Never been more optimistic. We've got Fed stimulus. We've got government stimulus. We've got an election year. They're like, there's just so much support. So look how fast things changed with the coronavirus. Now, it's very hard to predict what's going to happen. I can only say that I think it's a time for prudence. It's a time for over-delivering to other people, over-delivering value in your businesses. But if the economy, if this isn't behind us within about 8 weeks, I'd say 8 weeks max, I would say this could potentially tip us into some sort of deep recession like we've never seen. Now, the government's going to do everything they can to stop it, but there are some new risks that are being exposed here in the bond market and in the ultimately the fiat currencies themselves. And Credit Suisse put this out. This is not a conspiracy. This is not Alex Jones. It's not some radical talking about a currency crisis. This is actually Credit Suisse, JP Morgan, actually noting in their most recent investor calls, Goldman Sachs, that we have fiat currency risk. That is scary.
What does that mean? Can you elaborate? I don't even know what that is.
Sure. The fiat currencies are what we have today. So prior to 1971, the US dollar was backed by gold.
Mm-hmm.
Prior to 1933, you could actually take your dollars to a bank and exchange them for gold. And then prior to whatever, the next 1,000 years, the world had some sort of linking to an actual asset, something that had a value. Today, since 1971, we've been on a Bretton Woods standard or a petrodollar standard where the dollar became the reserve currency, but it's backed by nothing, but you can only use it for trade for oil. So that gave it value, that you needed these dollars to buy oil, which essentially allowed the US to borrow as much as they wanted because we could always borrow because everyone needed our debt and they needed our currency in order to get the oil. So that was a good relationship. It's starting to break down. But the real scary thing is with the Fed, I mean, let's look at the headlines. Yesterday, they pumped $500 billion into the market. This morning, they pumped $500 million. 3 days ago, they did $750 billion. Start doing the math, guys. This is insanity here, what we have here. We have negative rates. I mean, there's a lot of things that are firsts. And we've never seen a reserve currency used like this. We have seen other currencies used like this, and they always have the same result, which is hyperinflation, debauched currency, and the currency implodes on itself. We have the reserve currency doing this. The good news is that all governments and all central banks are doing this. So it's not as if the dollar is the only one doing it here, and everybody's going to turn against the US dollar. We have all currencies doing this at the same time. So what Credit Suisse is saying is there is a new risk here of the actual currencies themselves. Will they flush themselves down the drain here? I don't know. I sure hope not. But that is one of the reasons why I've told people I own cash and gold, because ultimately gold is just money. It's just an insurance policy. It's not an investment you want to go up. You know, when people compare gold to the Dow Jones or gold to real estate, that's absurd. Compare gold to the dollar. It's currency versus currency. And if you don't believe it's a currency, the central banks own gold. They print currency. Why would they own so much gold? Why have they been net buyers of gold since 2009? Ray Dalio, the most successful investor of all time. Compare his percentage gains to Warren Buffett. He makes Warren Buffett look like an amateur. Ray Dalio basically said the other day, if you don't own gold, you don't understand economics.
You think it's too late to buy more gold right now?
No, it's not. In my opinion, it's not. I think gold is now gold. You're going to see extreme volatility in all assets, but there is an opportunity in the gold market right now because what you're seeing is the physical metal to own it. There is shortages right now, especially in silver, but the COMEX where the gold market trades, or these ETFs you hear SLV, that they're all linked back to the COMEX, which is the Chicago Commodities Index, are trading. And that they sell for every 1 ounce of gold they have, they're selling about 100 to 200 ounces of gold. So think about that. That suppresses the price down so that the gold price is lower than it should be. Well, one thing that's on the table here, and I just did a video and alert about it, is let's say they close the New York Stock Exchange and the markets for even 10 days, which very well could happen. That happened in 9/11. That happened during World War I. They closed the stock market for 4 months.
Right.
So don't doubt that this can't happen, especially if you justify it by, if you lock New York City down and traders aren't allowed to go to their houses, done. They'll close the stock market. So let's say they close the stock market and these bullion dealers are still out there selling gold, but now they don't have to reference back to the COMEX price. They're just selling it for what supply and demand is at. That silver at $12 today is probably going to go to $50 to $100, and gold, which is trading for about $1,500, is probably going to go upwards of $2,500. When the markets reopen, those markets will be forced to actually go back to the real pricing. So they'll gap open, gap higher. So I think there's a situation where we have a potential asymmetrical risk on owning physical metal. I'm not talking about the ETFs or buying it and having somebody store it for you. I think there's a potential asymmetrical risk opportunity right now as I speak on March 18th of owning physical metal, because I don't understand how the bullion dealers are selling silver for $20 to $25, but the digital price, which has a lot more quantity because it doesn't actually have the metal, is selling it for 12. I think those two numbers are not sustainable. And we'll see what happens, especially because remember, when you're dealing with currency risks, nothing moves more than gold on currency risk.
Okay, so where should somebody go and buy gold right now? Should they buy actual physical gold or do the commodities exchange, or how
I
should
would
they do
only
it?
own it physically at this moment. Physically, like meaning somebody has proof that it's in their vault, not like SLV or GLD. Those are kind of known in the gold world that they're not to be trusted. But I would actually look. I'll tell you, I don't make a penny, but I use Miles Franklin, and the only reason I mention this is because I'm friends with the owner. They've been around for 30 years. But Andy Schechtman, Miles Franklin. If you tell him Daniel Ameduri sent you, he'll probably take very, very good care of you. And again, I don't make a penny from mentioning them, but that's who I have gold, physical gold delivered. And again, I'm buying this for protection. Ideally, I'd like to see gold not go up, you guys, because if gold goes to 3,000 or some crazy number, probably means we're living in a pretty shitty world. So as a father, it's the one investment, one asset that I own that I pray doesn't go up.
Okay, what was his name again?
Andy Schechtman at Miles Franklin. They have people there, but that's the owner. So if you actually went through him and let him know Daniel Ameduri sent you, I'm sure that you would get the royal treatment because I do buy a lot of gold from them.
Cool. Right on. Well, yeah, this is a ton of information here. I mean, we could keep on talking about this forever, but we all got stuff different things that are going on. But where can people find out more about you? You mentioned your website, your book, all that kind of stuff. Where can they reach out to you or just find out more about the resources you talked about here?
Yeah, if you go to futuremoneytrends.com/save, you guys can read the first chapter of the book and the intro. And then if you go to futuremoneytrends.com/checkmate, you can subscribe to our coronavirus updates.
All right. And your book again is?
Don't Save for Retirement.
Right here. I got it right here. So on YouTube,
Yeah.
That's what it looks like. All right. Well, Daniel, thanks for this information. This is great. I'm going to go look at your gold buddy there and look at some of that. And I hope it doesn't go where we think it's going to go, but
I sure hope not.
who knows? And maybe we'll have you back in 8 or 10 months or so, and we'll recap what happened and what's happening. So
Thanks, Justin.
appreciate it. Have a great day.
You have a good day, sir.
Bye.